Their IRR can change a lot based on a lot of assumptions in the future, where what I'm saying is that's reality today. Like you're looking at comps going, these are the rents right now at the other buildings that are similar. These are what the expenses are. This is where we're buying the building. Where IRR, you can push that up or down by changing your growth rates or your exit cap. And so I think for me, I want to see, enough of a spread. So on my untrended yield on cost, where we're above what the regular market cap rate would be, that you go, okay, this is like a no-brainer.
Welcome back to another episode of Keeping It Real Estate. I'm your co-host, Dan Breezy, and today we have Drew Breneman joining us on the show. Drew is a self-made entrepreneur. He started his journey with an internet business in high school, eventually building Breneman Capital, which is now a powerhouse in multifamily real estate investment with over $250 million in acquisitions. His remarkable rise from a duplex owning to $200 million in real estate is a testament of his unwavering dedication. With that said, Drew, welcome to the show.
Thanks for having me, Dan. Appreciate it.
Yeah, if you can, maybe you share a story of how you acquired your first rental property at just 19 years old. That is how old you were. Is that correct?
Yeah, I mean, so yeah, back in 2005, it would have been. I think as you had mentioned, I made some money with this internet business that I started in high school, and I had saved all the money from that business and was looking at what to invest it in. And I settled on it. Like I liked what real estate offered and wanted to buy my first property when I went to college at UW-Madison in Madison, Wisconsin. And I did. So I got a realtor and I started looking at deals and wasn't, I had read like 2 books. So it's interesting where I didn't like spend too much time on educating myself, if you will. Like I felt like I knew the basics and then focused really on just finding a deal that was cash flow positive and with a valuation that I understood. Like I understood gross rent multiplier, and that's how everyone was really evaluating those small deals, valuing them. So that's what I did. I found one that was going for a lower gross rent multiplier than usual and was cash flow positive, and I didn't overthink it. I just bought it and then moved into it, and the deal ended up going well.
That's crazy. I have a few questions that have come to mind. So you started an internet business in high school. What was the business and what made you start that?
Yeah, it was reselling items in online video games. So Diablo 2, EverQuest, World of Warcraft. People would have either gold or items on their character, and when they were done playing, they could sell them for real money, like separate, like outside of the game. So you would pay somebody through PayPal or have an auction on eBay, and then you'd sell your item, and then you'd meet them in the game and deliver it. So, and I just,
are you serious?
Yeah, I saw some of my friends playing the game, and they had said they sold some items for like 10 or 20 bucks. So it wasn't like a lot of money that any of them had made or in any one transaction that when I started doing it either. But it was just, I learned the market, and it's not too different than real estate really, where it was learn what things go for normally. And then when you see it selling for cheaper, I bought it, and then I resold it and just would do a buy it now auction on eBay at the top of the market, basically pricing, and wait for it to sell, and then make my delivery.
So what kind of money did you save up in high school? Are we talking like 50K, 200K? I mean, what can you share that?
Yeah, somewhere between $80,000 and $100,000. I don't have the exact amount, but I remember what I think I probably made $100,000, I'd say. And then through trying to day trade and trade options, I lost money. So then I at no point did I ever have 100,000, but I was pretty close. And then that's what I used for my down payment on my first deals.
Got it. And what's the difference between you think yourself, growing up that you made this money and instead of buying a car, you went and saved it and invested it? What did you hear growing up, or what values were taught to you that created that sort of result?
Yeah, I think it was definitely from my parents, where they were both teachers, so they weren't like in the business world at all. Where my mom was a speech pathologist, and my dad was a tech ed teacher, so they weren't like even teaching like business or math or anything, but yeah, they just, my dad talked about investing in mutual funds, and I was just always interested in business. Just even as a kid, I did all sorts of little other stuff before that. Didn't really make any real money doing it, but I was always the person who, like, if there was like a lemonade stand or something going on, like I just, I wanted to do it and I wanted to make money on it. And so I just was kind of always naturally interested in that. And then it was something my parents talked about, especially my dad. talked about investing in mutual funds and would explain how it was going. And, I would have been starting high school with like the .com craze and all that. So every commercial was about investing, on E-Trade or wherever back then. So yeah, so no, just kind of things I heard from my parents. And then, and they were not like they weren't like pushing me to do any investing or the business, but then they weren't like against it. They weren't, some parents where they're saying, don't do that. It might be illegal or, which it wasn't, but just like where they're kind of telling you like, something else, like don't spend time on it or, as long as I was still getting good grades and, didn't quit every sport I was in. I mean, they were kind of, they were supportive of it, but not pushing me any one way.
Yeah, so it sounds like your parents really instilled the habit of saving, and you picked it up from them. And then do you remember what 2 books you read that inspired you enough and said, "Yeah, I've got enough confidence to go for a buy here, my first purchase"? How old were you? 20?
Yeah, well, I mean, when I first started looking, I would have been 18 and then bought when I was 19. One of them was called Investing in Real Estate by Gary Eldred. The other one, to be honest, I don't remember what it was called, but the Investing in Real Estate by Gary Eldred, that's the most practical like real estate investing book I've ever read, where there's no fluff in it. It's a lot of just tips and then on how to manage properties and then kind of just the basics on how to value them and then what the benefits of real estate investing are. That's where the light bulb went off for me when you're talking about the cash flow, the appreciation, the tax breaks, paying your loan down over time. Like that was sort of the light bulb moment for me where I was like, wow, the returns on this could actually be pretty high. And then, seems like, and I mean, I'm just, so young at that point, I don't really know for sure, but it seems like the risk could be somewhere between like stocks and bonds. But because there's so much more work involved, the returns are kind of higher because it like weeds a lot of people out, that aren't willing to do this work.
Yeah, got it. Okay. So you learned the gross rent multiplier and you're looking for cash flow. So, looking at your first deal, what gross rent multiplier were you looking for? What sort of cash flow were you looking for? You were like, yep, I'm going to take this risk and go in and buy this.
Really for me, so I was thinking of living in it, and that was the plan. So then I assumed like if I had rented it out, like I wanted to be cash flow positive, at least a couple $100s a month. This was more for like a cushion versus like I really needed to be at a certain cash on cash return. It was more about where I'm sure at the time I would have had a number where I would have told someone like, yeah, I want to make, 6% or 8% or whatever the number was. But it was really more about just having a cushion. Cause I remember explaining to people like, I don't really understand every part of this, but if I think I can figure out the rents and then my expenses, like what would the utilities be and insurance, and like you can get quotes and estimates on all this stuff. And so I did that. So then I felt confident that at least I'm understanding the month to month cost well, and that this worst case is if the market drops or I overpay for the property, I'll just hold it. I'm paying my loan down. I'm cash flow positive. Like, things could be a lot worse.
And what is a gross rent multiplier? I mean, you don't hear that term in multifamily. What is it?
Oh yeah. So, I mean, that's how people in the, let's call it like 1 to 4 unit space. I think that's how they do value them. Like they don't use cap rate as much where, you take the annual gross rents and then multiply it by whatever this number is. It's similar to a cap rate where it's like a filler number you're solving for. And then that's the value of the property. So to learn what's the gross rent multiplier in your market is you look at the stuff that comes up for sale and you track it. So let's say the annual rents are $30,000 a year, and then you look and then you see, oh, it's sold for $300,000, and then you see that happen enough times, and you go, okay, for that kind of property, this is a 10 GRM property. 300,000 divided by 30,000 a year is 10. And so then you don't come up with what gross rent multiplier. It's similar to the cap rate. Like it's not up to us what the market cap rate is. You're observing what's going on. And then when you see, and there's differences, with gross rent multiplier, if the utilities are paid by the landlord or it's a really old property, like the gross rent multiplier should be lower. And then, and then the opposite's true as well. Newer, nicer, all tenant paid utilities, gross rent multiplier will be higher. And so I think, but then after you see enough deals come through and you see a property where you're like, wow, this, if anything, is like a low GRM, should be higher. Like that's the one to buy. And that's what I did.
Yeah. Cool. Simple. Didn't overanalyze. Got some basic knowledge. Went in with some cushion of cash flow and off to the races. Looking back, would you have done anything differently, or are you happy with how it went for your first purchase?
No, I think it went great. I ended up the rents were way below market, and I was able to raise the rents a ton. I mean, this is, almost 20 years ago, so hard to remember every detail. But yeah, I bought it for 216,000. I sold it for like 270 a year later. Where it wasn't my plan just to own something for a year, but I had signed 2 leases that were so much higher, and then the market was improving every year pretty rapidly back in 2005. So then yeah, just decided to sell, and by then I had bought three properties total, so I had other deals too, and was looking at buying a fourth one, which I eventually bought as well. So
Got it. Did you have any pain as the Great Recession unfolded, or did you get by with selling at the right time and liquidating?
yeah, I did. I have. I mean, I sold 2 deals before prices dropped, and then I still had two properties. But fortunately, these were student rentals, so the income at the rents never dropped at the properties. They every year I raised the rents. But yeah, at one point I remember thinking about, should I just sell both these, and they were worth my loan amount at the time. Things had dropped a lot, but I didn't. I didn't sell, and I held them, and then they went well. So kind of a similar thing to think about today, where on the one of the deals I bought, I had paid 670,000 for it. Fast forward like in 2007, and then 2009, thinking about selling it, and it's like you had this whole like plan where you raised the rents a lot, expanded into the basement to add more bedrooms, and then you do all that work, and it's worth less than 670. Fast forward to 2017, so whatever 8 years later, and I sold the thing for $1,220,000. So like that was, I'm based on that deal, I made $1 million, including cash flow on a 3 unit. But just because of time.
Yep. Yeah, got it. So, talking about that being, it just came up in the conversation naturally. You got a period of time where you're seeing valuations push down tremendously. Where do you think we are in the market cycle as far as bottoming, gonna bottom? What's your crystal ball, if you had one, to say where we are in the cycle?
Yeah, I think to give some context to what I'm doing now, I have apartments that are in Chicago, in the city of Chicago, and all the nice neighborhoods there, which is where I was living from 2012 till last year. And then I have 5 properties in Phoenix as well. But I moved to Austin, Texas last year. So I'm looking at it like through a different, I have different markets that we're participating in and looking at expanding into in the future. And I think the Midwest, it already had its price adjustment where cap rates went up, so prices went down when interest rates went up so much. But operations have still been really strong. We've raised rents more on those Chicago deals in 2022 and 2023 more than any other years. I mean, we raised rents back to back 6% a year, and we're at on basically every unit a record rent level. And with the start to this year so far, it's been this is another year like that kind of starting. So in the Midwest, I think with that, it already happened. I think things already bottomed out. It was just a response to rates going up. And then and then I think in the Sun Belt, there's still a lot of deals that got bought where people were buying them with 3-year floating rate bridge loans. And then I think those deals, they need, a lot of those deals are going to come back around for sale. And I think the market will need to work through those, as well as like the operations are still declining in a lot of those markets where vacancies ticking up, rents are dropping, delinquencies are going up. So I think the Sun Belt still has more room to potentially drop, but that's more, I think, operationally driven than capital markets driven.
Got it. I love it. So going back a little bit, so you bought a single unit property and now you're buying, what's your typical purchase now when you're buying something?
Yeah, 10 million to 35 million is what our buy box the last 5 years. So, and then we focus on, we were expanding into the Sun Belt more as the Sun Belt has been on such a tear until the last couple of years. But today we were focused more on the Midwest, just for, like I had said, the relative strength and stability near term. And then also I'm from Wisconsin and used to live in Minnesota and then in Illinois. So I'd already familiar with a lot of the markets there. So 10 to 35 million, newer, nicer stuff. We're usually not doing like real heavy value add. programs where it's usually something built, let's say, since most of the deals have been built since 2005. A lot of just failed condo deals or new deals that got built up and then poorly leased up, or leased up fine, and then the market improved a lot, and then they didn't keep pace with the rents. So yeah, we're somewhere kind of between value add and core plus in terms of like a return and a risk profile.
And with you guys, you've told how many units under management again?
To be honest, that's not something that I track too hard, where I know we have this 235 million of property, but I don't have the unit count.
Okay. Gotcha. How many properties is it?
27.
27.
So I know a lot of people
between...
they like to know how many doors they got, but I mean, you sell one and then it changes and it's like a random number of sorts. And then we skipped over. From 2009 to 2012, I bought all commercial properties. So I have still 4 shopping centers that I own with one partner, and then a couple other commercial deals. So that's factored in there too.
Got it. Okay. And so how did you transition from the single family to multifamily and turn your buy box in from a $100,000 purchase to a $10 to $35 million purchase?
Yeah, I mean, just over the course of 15 years, just start kind of slowly stepping up in deal size. I had a big jump in 2009 where, previously the first 4 deals that I bought were those ones in Madison with my own money, and then I met an investor and we started looking at bigger deals. Relatively speaking, when we bought a $2.5 million shopping center, and then another deal for $2 million, then one for $5 million, then one for $5 million, another one for $5 million. So then we started that being more in that range. But then, stayed in that price range really for the next 10 years, kind of somewhere between 2 and 8 million, just recycling the money that I was working with them.
Yeah. Are you guys raising the money, or is it all your own capital, or how do you guys source equity?
So initially it was just one investor, a coworker of mine, and then his father. That was the equity. That was the first from 2009 to 2019. That's all I did was just what they had to invest, and then recycling that money, sell a deal, buy another one, or do a cash out refi. So the 3 of us, we bought $100 million of property in 2009 to 2019. And then at that point they had invested really the bulk of the money they wanted. And then I started taking on other investors, because over that 10 years, I had people interested in investing, but wasn't really set up to take outside money. Because we had for that group of properties, like the guy's daughter doing our accounting as well, and the son's in the business. So then, up to that point, I just said we're not really set up to take like a $50,000 investor or anything. And so at some point, I knew I would, and in 2019 we started doing that. So now we're syndicating and just raising money from individuals, investing anywhere from 50,000 on up. A deal we bought last year, we had one group come in for $3.5 million, another handful, two people putting in $500,000, and then everyone else somewhere between 50,000 and 250,000.
Got it. Yeah, that's the exact same way we're set up as well, with syndication model, where our minimum is 60, and you've got some folks who will come in for more. So that's great. How has that been for you guys in comparison with the 3 investors for the first decade, or 2 investors?
Yeah, well, it was really nice when you just already knew the money was there, but also that limited our growth. So there's pluses and minuses. Like looking back on it, I think it limited our growth, but I wasn't thinking about it that way. I was excited. I was doing larger deals and they were going well, and we were putting up high returns and everyone was happy. So I didn't think of it that way, at the time. Now in retrospect, I kind of do. Like we could have also taken on outside money or hired staff or anything, but
yeah,
which we didn't. I mean, every deal we found in that, first 15 years was just me finding it and underwriting it and doing all the steps basically.
With the deals that you have, the 27, do you have any that are struggling, or have they all just been pretty much pieces of cake and great returns?
If you would ask me that in 2019, I would have said, yeah, every deal's really, it's overperformed. We thought this would happen, and then we've done better with rents. Interest rates went from 6% to 3%. So we're killing it on every deal. But we had one building in one of the retail deals in Minneapolis that got looted in all the George Floyd stuff. And so it got set on fire, and it's a 2-tenant retail deal, and one of the tenants, after all that, they closed up shop, and they at the point they were in their lease, they could terminate the lease if their premises was destroyed, and it was, and they ended their lease, and we haven't re-rented it since. So now we've been half full for going on 4 years. So that actually went from being our best deal to like and now like more middle of the pack, where from 2009 to 2020 we invested $520,000 on that deal of equity, and we had distributed out over $2 million of cash flow and then proceeds from a refinance. So we had 4 times our money on that deal without selling it. So that one we were doing great, but then now that one's been cash flow negative since we lost the tenant, but to an amount where, if you have 27 properties and you're adding a little bit of money on one, like you're still heavily cash flow positive. So, I mean, that's been the most notable laggard out of the group. And that's why it's nice to have a portfolio of properties where you're not going to eliminate every risk. But if you just own that one and you had all your eggs in one basket, where, 2 tenants, and when one leaves, you're half full, that would really be tough. But yeah, with a bunch of other properties that are cash flow positive, we just distribute the money out to all of us, and then me and the other owner add our money back into that one.
Yeah. So. Well, any changes you've seen in the multifamily space specifically pre-COVID to now that has been challenges that you've solved issues for and changed or pivoted to improve operations?
Well, we were late to get going in Phoenix. I mean, that's the biggest thing that comes to my mind. Like, we saw all the rapid growth there and wanted to participate in it. So we bought, in 2021 and 2022. So not at the peak of the market, but pretty dang close. So, I mean, that's when I think of like things that I wish we, had changed. I mean, that, some of those deals I wish we would have waited to buy. But in terms of operationally, yeah, I mean, we've just continually improved over the last, 15 years, where one thing we do is we keep track of, all of the income and expenses for every deal by year. It's all like laid out next to each other. So we could tell you what we're running per unit for every line item the last, 15 years in Chicago or in Phoenix since we entered. And so we've been able to like dial in the analytics a lot more and be underwriting the reality of how we actually operate the deals, which has been a plus. And then that's an advantage in the markets we're already in, where we already really know what the rents should be or could be, what the operating expenses are, which is a big advantage to compare when you're brand new somewhere and you're just kind of looking at people's T12s and taking the broker's, info. And so.
Yeah. So just so people can understand that on a deeper level, what you're saying is, for 15 years and having many different deals in submarkets of, say, Chicago, you're tracking exactly where your rents were over a 15-year period and how your expenses moved over a 15-year period. And now when you're underwriting deals, you can look back, or you could use the data to help you underwrite future deals. Is that correct?
Exactly right. I mean, it's pretty much every deal that we look at, we go, okay, this is very similar to these 2 deals we already own. Then we go in this Excel file, it's all warehoused in, and you look it up and go, here's what it's been running at. And that was actually before we were doing the podcast. I was doing that on a deal we're looking at, and it's like we have 2 deals just like it with the same kind of construction, the same elevator, the same. So let's open it up and let's make sure we got the right hallway cleaning and elevator amount budgeted, and the utilities don't seem on this one, like the new one, way lower than what we're experiencing at the others, and that we have the real expenses in there. And then because we underwrite deals before we go tour them, and so that we have that all set up, and then we're going to tour it tomorrow, and then we'll get the rents dialed in once we see it a bit more in person.
Yeah, that's great. I love that. So with Breneman Capital specializing, it sounds like, in data-driven investment approaches, what specific data points or metrics do you guys prioritize when evaluating a potential investment? Is that what you're getting at right here with keeping track of the data and then using it looking forward?
Yeah, I mean, we have a lot of different tools. I mean, but in terms of the main thing that I think is the most important on a given deal is looking at your untrended yield on cost. So for those that haven't heard that term before, essentially that's what cap rate are you stabilizing the deal to? So you're taking since the untrended means not grown. So you would take what you think the market rents should be for every unit today, and then minus the expenses that are tax adjusted. So if the taxes are going to change post purchase, you're taking the real expenses. Then you have the NOI. That's where, so this is where you will eventually stabilize the property to. So let's say you buy a property that has rents below market, and then the taxes are going to jump, and then you're going to maybe run it with a different set of expenses. You make a pro forma where all that stuff has happened. If you could just snap your fingers and it would happen immediately. And then you look at, okay, that's, income minus expenses. So you have your net operating income, and then divide your NOI by your purchase price. That's your effective cap rate, like where you're stabilizing to. And that's what I think the most important metric, where, people talk about what their IRR is or whatever, but, your IRR can change a lot based on a lot of assumptions in the future, where what I'm saying is that's reality today. Like, you're looking at comps going, these are the rents right now at the other buildings that are similar. These are what the expenses are. This is where we're buying the building. Where IRR, you can push that up or down by changing your growth rates or your exit cap. And so I think for me, I want to see, enough of a spread. So on my untrended yield on cost, where we're above what the regular market cap rate would be, that you go, okay, this is like a no brainer. So, and what amount kind of depends on the market. So like in Chicago now, most nice deals are selling for right around a 6 cap. So, ideally we're getting to a 7 or pretty close to a 7 yield on cost. Cause then, it's basically like once you do your thing to it, it's like you bought it at a 7 cap, and you're going to make a good return with that. Like, that's, interest rates are in the mid to high 5s today on that kind of property. And then so you have a lot of positive leverage and a big spread to where, other buyers are buying properties. So you have a profit that you're creating, and you have high cash flow. So, I mean, that's the word, so that's the way I look at it. In other markets, Phoenix is still lower cap rate than Chicago. So you're not going to ever get anything to a 7 cap there on real numbers. But so you need to adjust for what market you're in. But if, I mean, to me, that's the number one metric when looking at a deal.
I love it. Thanks for sharing. And I think a big piece with real estate is simply timing of where you are in a cycle. And like we're talking about here, we went through a peak, and it's pretty much undeniable. Like Drew was saying, back in late 2021, early 2022, multifamily peaked. And since then, we've seen some huge pullback in pricing due to interest rates rising. And it allows for those that know what they're doing to get into deals at a better cost basis. And you're for those that have the ability to understand the opportunity, they're getting into deals now. Where you have a lot of folks who unfortunately got burned in 2021 and in 2022, and they're in deals with short-term loans, and now they're saying multifamily doesn't work. Well, the asset class works depending on the timing and depending on who's the operator. So you got to understand a little bit more of what happened versus looking in the rearview mirror to invest in the future. And I think that's a lot of what's being said as well with the untrended, untrended yield on cost, I think is how you termed it.
Yeah. And I think what you're saying is right, Dan, where, rents dropped, values dropped. I mean, in most markets, on the rents, I mean, everywhere values drop, and now people are using fixed rate loans, to win deals again. And like the numbers today make sense, where, now looking back, the numbers from 2-3 years ago, you go, wow, yeah, everything was priced to perfection. And the deals you bought, you look at your model and go like, geez, feels really aggressive now. At the time it didn't, things were going up 10% a year for a little bit. So you underwrite, 5 or 6%, you feel like you're being conservative, but normally you were doing 2 or 3%. So yeah, a lot of the things like that could go wrong have gone wrong now. And that's like factored in on the new purchases. So yeah, this is I think in retrospect going to be a really good time to buy. Yeah. It's hard to get your numbers to make sense, to work when you have all these much more conservative assumptions and putting more money down. But yeah, I think in retrospect, all those deals I bought in 2009, 10, 11, we crushed it on all those, and everyone would, looking back on it was like, oh, it's so easy. You just bought in 2009. Like, of course, every deal you're going to make money. But we were the only bidders on those deals. No one else was making an offer. Everyone was on the sidelines. It was a hard time to put deals together, which is not too different from today.
Yeah, agreed. doesn't seem like it's true. Back in 2021, you had 15, 20 offers, and the brokers basically stiff-armed you and said, get up now or you're out. And now they're basically begging for an offer and saying, please, just even if you're 20% off on the whisper price, just submit something. Give us a bone to chew on. And it's a buyer's market now, and this is the time. You got to back up and realize what's taken place and the opportunity. The buying window is open, and get after it. That's where we're at. One kind of thing to touch on before we wrap this up is mistakes LPs are making today. What would be, from your perspective, the biggest mistakes that limited partners are making?
Yeah, I mean, I think the main one that I see, and it's, I mean, it's not just today. It is today, but it's been going on for a long time. It's what I call return chasing. So, you look at two deals, and let's say one is it's a half full office building, and the business plan is you're going to buy it, you're going to fill it up and then sell it. And the other one is you're going to buy an existing apartment building and just run it a little better and cash flow it. And people will look at the office building and be like, wow, a 20% IRR, and we can like double our money in 4 years. Like that's a great return. And then maybe they look at the apartment building and they go, this is a 12% return. It's not as exciting. I'd rather do the office deal. And they just jump to whatever has the higher returns. And I guess I'm using pretty extreme examples, but the thing is, I mean, all these sponsors, they're doing their best to like project returns, using like reasonable assumptions, I feel like, and they're not like making up the numbers, but the thing is, they're projections. So the office deal, like, look at the numbers if they don't rent out the other half. Like, how does it look? Like the prior owner you're buying from didn't rent it out. Like they're selling it half full in this example. So like you really need to, factor in the risk. And so I think that's like missed on a lot of people, like where the deals that raise the most money, they're just seems like they're the highest octane, riskiest ones because they can put out a high return. I see you get emailed these deals where it's a 3-year hold and a 28% IRR and whatnot, but then they have to buy it, build it, and lease it up and sell it in 3 years. And you're like, there's so much execution risk there where, to me, real estate's more about like building wealth long term. So most of the deals that we own, they're all 7-10-year holds, a lot even longer. The ones we're syndicating are typically 7 or 10-year holds. But yeah, I've bought deals from like one family in Chicago where they bought like 50 duplexes back in the 1970s in a really nice neighborhood there when duplexes would have been 10, 20,000 each. And now they're all $1 million each. And it's just the cash flow on those and the equity they built up, they probably made, $80, $90 million just with the world's simplest strategy. Like we just bought a bunch of duplexes and ran them. And that's like assuming they didn't do anything the next 40 years with like reinvesting the money. So, I think people, they get too enamored with like high projected returns. And then I guess secondly, not looking at the risk. I guess that goes kind of hand in hand. Another thing that comes to mind is I think they don't like match up the investment necessarily with their individual goals. Like a lot of people I talk to a lot of passive investors, and they all say like they want like cash flow, let's say, like this. I feel like also because they don't even know what else to say. Like sometimes if you are actually a cash flow investor, like don't look at the apartment deal that needs a heavy rehab or a development deal or this office lease up play. I just, in my hypothetical, like focus on something that's generating cash flow right now and you go for what you're targeting. Don't get distracted by like, oh, hey, this development deal looks nice. Like if you need to match up your goals where, some people, they don't need any cash flow. They already have a high income and they're trying to build wealth. Well, then maybe these deals that have less cash flow, but have higher appreciation, like that's better for you. And I feel like they don't really factor that in. They just kind of see a deal and then decide like, well, do I want to do this one? And just like without thinking of the whole plan that they have.
Yeah, no, it's great stuff. I appreciate that. Before we part ways, I'd love to give our listeners a book recommendation. You already gave us one. Is there anything else that you want to leave that would leave a positive impact for real estate investors on our show?
Yeah, I think if you're a passive investor, we wrote a passive investing guidebook that's on our website. If you just go to breneman.com, it's on there under the download section, and it's 100 pages and goes through kind of how passive investing works, all the terminology used. I kind of get into some of the stuff like when I'm talking about like risk and then return chasing, like that's in there, as well as a bunch of other stuff. And then, for active investors, I mean, the one book I had mentioned already was that it was Investing in Real Estate by Gary Eldred. for a more like advanced book, there's one from Gary Rappaport is his name, and it has the title. I don't have it on. I don't have it in front of me, but it has to do. It's the title says investing in shopping centers or something to that effect, but the book isn't really that much about shopping centers. It's more about how to set up deals with investors. And so he goes through a really nice breakdown on how he sets up all his deals. And like that book, I think helped me a lot, as well as I guess I had, there's an article that someone that went to Wharton for business school sent me on that breaks down like how a waterfall works and like what a catch up is. And that was helpful. If anybody wants that, they could reach out to me. I could just email that to them, I guess. So, but yeah, cool. Those two come to mind. So,
all right. Well, thank you so much, Drew, for joining us on the show today. And thank you so much for tuning in to another episode of Keeping It Real Estate. Please do us a huge favor and leave us a rating and review. It helps us continue to bring on great guests and provide great content. Thank you so much. We'll see you on next week of Keeping It Real Estate.